Although South Korea recently experienced a devastating stock market crash, Seoul is merely the first stop in a far more dangerous financial chain reaction. There is only one country on Earth holding American artificial intelligence by the throat. Over the past 3 years, this single nation has triggered four separate market shocks. Each time it rattled Wall Street and proved it can burst the global AI bubble at a moment's notice. This graph tracks US markets over the last several years. Look at July 2024. The VIX Fear Index spiked to 65.7, and US tech stocks dropped 16%. Then in January 2025, they tumbled another 25%. We saw it again with a 12% drop in December 2025 and an additional 8% slide in June 2026. If you overlay these drops, a strict pattern emerges. Every major American stock market crash over the last several years happened right after Japan raised interest rates. The trillions of dollars driving US equities higher were originally borrowed from Japan. As long as Japan cannot withdraw its money, American tech stocks can keep climbing, but when they pull that capital back, Wall Street collapses. To understand why, we have to look at the ultimate arbitrage maneuver, the yen carry trade. Because Japan maintained zero or negative interest rates for decades, borrowing yen cost virtually nothing. Investors worldwide executed a simple loop. They borrowed yen, converted those yen into US dollars, and poured that cash directly into American markets. When the Federal Reserve pushed interest rates to 5% in 2022, this massive capital flow aggressively targeted American tech giants like Nvidia, propelling them to historic valuations. Direct yen borrowing amounts to roughly 1.3 trillion to 1.7 trillion. But when you factor in leverage, investors using those stocks as collateral to borrow even more, that figure surges to $19 trillion. Given that the total market capitalization of the US stocks hovers around $60 to $70 trillion, nearly one-third of the entire US stock market is funded by cheap Japanese credit. If the yen strengthens, investors' debt obligations explode. Their stock gains are wiped out, forcing them to liquidate their holdings all at once to pay back their loans. So why doesn't the United States simply cut ties with Japanese finance and protect its tech sector? This 3D breakdown highlights Japan's physical grip on the AI economy. Out of 19 essential semiconductor materials, Japan holds the world's leading market share in 14 of them. In semiconductor equipment, they control over 70% of the global market across 76 critical technologies. Industry titans like Tokyo Electron and Advantest supply the basic building blocks and precision tools required for advanced chip manufacturing. About 80 to 90% of their revenue comes from Asian manufacturing hubs. These sell raw materials to midstream fabrication plants like TSMC and Samsung, who transform those materials into the finished chips purchased by downstream American giants. Even though the materials flow to Asia, Silicon Valley is the ultimate buyer. If Japan halts exports of these materials and machines to those Asian factories, global chip fabrication comes to a standstill, and the AI narrative vanishes overnight. To keep Japan from cutting off supplies, American capitalists force Japan to keep selling materials cheaply. They achieve this by relentlessly shorting the yen, betting against the currency to drive its value down. A depreciating yen drops Japanese export prices, lowering input costs for US tech companies and inflating stock valuations. But for Japanese citizens, it slashes domestic purchasing power, inflates import costs, and creates severe cash flow pressures inside the country. When you need cash, you are forced to sell your key exports, even at a discount. This diagram maps out a self-reinforcing energy trap. Japan produces almost no domestic energy, importing over 90% of its oil. Because oil is priced in US dollars, rising energy prices force Japan to exchange vast amounts of yen for greenbacks, continually driving their own currency down just to keep the lights on. Wall Street hedge funds capitalized on this exact death spiral. By June 2026, they had shorted a massive 137,000 yen contracts, the highest short position since 2008, pushing the currency to a 40-year low. This orchestrated macroeconomic warfare directly impacts the stability of your personal portfolio. Navigating massive liquidity traps requires real strategy, not speculation. At Stewardship Finance Academy, we want to ensure you are protected. That is why we are offering the completely free SFA Stock Investment Masterclass. You will learn to identify high probability entry points and protect your wealth from sudden crashes. Click the first link in the description below to register today. Over the past 2 years, the Bank of Japan has attempted to fight back. Their rate hikes in 2024 and 2025 temporarily boosted the yen, but by mid-2026, those hikes failed to spark a rally. They even deployed a record-breaking $73 billion to buy yen and support the exchange rate, but commercial demand for dollars completely overwhelmed their buying power. Now, Japan is turning to its final option, aggressive balance sheet reduction, ending decades of monetary stimulus. This quantitative tightening is pushing 30-year Japanese government bond yields toward 4%, closing the gap with U.S. Treasuries. If Japanese yields rival American yields, this escalating financial war forces the global economy into one of two catastrophic endgames. In Scenario 1, Wall Street successfully keeps the yen depressed. Inflation and severe debt servicing costs ultimately crush the Japanese economy. As the core hardware supplier for global tech, a Japanese collapse would completely shatter the Asian supply chain. TSMC, Samsung, and neighboring economies would be dragged down in a massive regional financial tsunami. In Scenario 2, Japan's quantitative tightening succeeds. Global carry trade capital reverses course, flowing rapidly back into Japan, and the yen skyrockets. Because a stronger yen makes existing loans drastically more expensive to repay, trillions in borrowed yen would be forced to unwind immediately. Global investors would dump U.S. stocks en masse to cover their exploding yen-denominated debt. The sudden liquidation would cause megacaps like Nvidia, Microsoft, and Apple to plummet, triggering a global financial crash worse than 2008. Whether Japan succumbs to the pressure and supply chains collapse, or they trigger a historic carry trade unwind, the AI bubble is living on borrowed time. A major global liquidity adjustment is already underway. The fallout from this clash will redefine global markets for the next decade. Make sure you are prepared. Join the free SFA Stock Investment Masterclass today through the link in the description. Subscribe to Stewardship Finance Academy, turn on notifications, and share this video with anyone looking to protect their wealth. I'll see you next week.